Hi, and welcome back to Hedge Fund Manager. So let's wrap up this deep dive into Centene. As I finished off in the fundamentals section with saying that ultimately I expect Centene to recover most of its fundamentals, and when it does, it should also recover its valuation multiples. So what I'm really saying here that this is a status quo type of situation. This is just a super tanker. It's kind of hit a slight bump, and this bump it triggered an overreaction because of the turmoils regarding Doge and the new administration in the US. But this is a more than 40-year-old healthcare company with $16 billion market capitalization. It should be at maybe $30 billion. So this is a big company, and it's veered slightly off track. But I have almost no hesitation, but of course there is always a hesitation. As I started out with saying, there is always a gamble because we don't really know what's going on. We are uncertain. Even the company management is uncertain, and their uncertainty in their communication is also what's shining through in this stock price crash. But what I'm seeing is that even if this is a bit of a falling knife situation, as probabilities goes and as reversion to the mean goes for these type of situations, and nothing new under the sun, all of that, I think that more likely than not, they will get back to producing just about their typical margins. They will start correcting whatever went wrong in terms of enrollment and enrollment mix. I mean, these things are built on the law of large numbers. It's not like the US population has suddenly overnight completely changed, and it's also not as if the US government or the management of Centene will just idly sit by as costs increase by not adjusting their revenues and their pricing. They are allowed to adjust their pricing, and they are allowed to pull other cost levers. So slowly, but I would say certainly, they will get back on track. And when they get back on track, and remember, getting back on track here does not mean hyper accelerated growth. I mean, I wouldn't even have to assume that they grow at all. But of course, a big healthcare company will grow more or less nominally with the general economy, or perhaps even just stay flat if there are some unusually high reductions and savings from the government on Medicare and Medicaid. But I cannot see how a populist president would start tampering too much with these kinds of programs. So anyway, I'm not foreseeing or forecasting and I don't have to forecast hypergrowth or an acceleration in growth. I'm just hoping or seeing that they will just keep existing more or less as they are, as a part of the government operations in order to take care of the elderly and the sick in the US. So they are simply, my assumption is simply that they don't disappear. So this takes us to the summary of the F equals P equals F times V equation. So F, fundamentals, pretty stable, maybe plus 3% per year, just keeping up with inflation or so. It could be better, it could be worse. And in terms of bets and alternatives, this is a place to park your money rather than in fiat, rather than in just currency. So this is a This is a real investment. It's an investment in a real asset, something that is exposed to the general growth and development of the economy. Of course, it could be slightly better and it could be slightly worse, but more or less just assume that F is perhaps at a real growth rate of 0, perhaps a nominal growth rate, which is the relevant measure for the stock price, of maybe 3%. And then we take a look at valuation, because that is where the action is in Centene. They should easily double their enterprise value to sales in about 2 years if they just stabilize the situation and show that the profitability isn't just completely out of whack here. It could even triple in 3 years. I mean, remember, we're down at about 0.1 in terms of EV to sales, and the price earnings ratio is just, it's down at 10x, less than 10x actually, on reduced forecasts. So this promises maybe 40% per year in share price appreciation, maybe even 40% in 3 years, to a tripling of enterprise value to sales. And this is based on flat fundamentals. So it's only the valuation part. Maybe this is a good time for me to emphasize that predicting a re-rating, predicting higher or lower valuation multiples in the future than has been prevalent before, or the valuation levels that are present right here, right now, that is kind of a risky game. But remember, we have just in a very short time span visited this super extreme low valuation multiple for a couple of reasons. Probably this coming together, this convergence of political risk factors and company issuing their guidance, reducing forecasts, and then them saying that we will have to wait for even more information, which might even be negative. So we're in for maybe a quarter or two more of continued negative information. But looking at the share price, this seems to be already discounted in all the ways that I can see it. So what we're trying to do as fundamental analysts is seeing through the noise of temporary hype or despair. So this could be based on, for example, things like this, like the political discussions and this reduced guidance. So the reduced guidance has led to kind of a share price puke, people being fed up with just this slow moving stock that never really produces anything, except for actually it has produced a very decent annual return for a very long time, except for these last few years. So it's been creeping into the share price, and then suddenly you got it all at once because of this reduced guidance. But I think the reaction is an overreaction. The question is it worth the risk that we don't really know what's going on? Maybe there is something much worse going on behind the scenes that we have no idea of. Is it worth a 40% CAGR potential for 2 to 3 years? I think it is, but we don't know. But is it really worth, is the risk really as high as 40% per year as the CAGR promise is? I don't think that the risk is that high. I mean, this is more or less a government-sponsored entity, and I definitely think that they will get back on track. Maybe not absolutely fully, maybe not as quickly as in just 2 or 3 years, but even if they just regain 50% of their former shine and 50% of the just recently actually low valuations, then this is a really good buy.